Every raise you've ever gotten has been quietly stolen. Not by the government, not by inflation, by your own expectations. You earned more, you spent more, and somehow the gap between what you make and what you keep stayed exactly the same. That's not bad luck. That's lifestyle inflation, and it is the most invisible tax in the world. Here's how it works. You get a promotion, a salary bump, a bonus. For about 3 weeks, it feels like progress. Then the new apartment, the upgraded car, the nicer restaurants, the better holidays, the brands you never used to buy. And within 6 months, your expenses have risen to meet your income almost perfectly. Economists call this hedonic adaptation. Your brain resets its baseline of normal upward, automatically, invisibly, relentlessly. The money arrived. The money disappeared, and you have almost nothing to show for it. This isn't about discipline. It's about how the brain is wired. Human beings don't experience wealth in absolute terms. We experience it in relative terms, compared to where we were and compared to the people around us. When you earn more, your reference point shifts. What felt like a luxury last year feels like a necessity this year. None of it feels like excess because your brain has redrawn the line of normal, and that line only moves in one direction. Let's make this concrete. The average professional gets a salary increase of 5 to 10% per year. Studies consistently show that lifestyle spending rises to absorb 80 to 100% of every income increase within 12 months. That means for every extra $100 you earn, $80 to $100 disappears into a higher standard of living. Not into savings, not into assets, into a new baseline that you now cannot afford to drop. The cruelest part? The more you earn, the bigger the tax becomes. A $5,000 raise doesn't just cost you the upgraded funds. It costs you the compound interest that money would have earned for the next 30 years. There are 3 specific moments when lifestyle inflation strikes hardest. The first raise, the social upgrade, the windfall. The wealthy don't earn more than everyone else because they're smarter. They keep more than everyone else because they refuse to let their lifestyle consume their gains. Warren Buffett still lives in the house he bought in 1958, not because he can't afford otherwise, because he understood that the upgrade is the trap. The goal is not a higher standard of living. The goal is a higher standard of wealth. And those two things are in direct competition. Every time your income rises, you have a window, a brief moment before your brain recalibrates. That window is where wealth is built, or quietly surrendered. So now you understand the tax. You can see it. You can name it, because the other side of this equation isn't just spending less. It's learning to think about money the way wealthy people actually do. In the next video, we look at exactly that. Why rich people buy assets and you buy things. And the specific mindset shift that separates people who build wealth from people who just earn it. That video is already up. Go watch it now.